Chuck Carvel. I'm the Chuck in the Markets Up Chuck, and today's blog was titled Behavioral Finance. You know, there's an awful lot being written here recently about behavioral finance. In fact, there was an interesting article I read in the Wall Street Journal talking about the way people make decisions. And, you know, the bottom line is with investing, it's really all about, keeping emotions, in my view, from corroding the framework of your intellect. In other words, ultimately fear and greed are very emotional responses that investors face. And as behavioral finance points out, fear is the most powerful. In fact, as I said in the written part of the blog, people fear or feel the pain of loss 2.5 times greater than they feel the pleasure of gain. So, the reality of it is, how do you fight that? And the way you fight that is to have a real sense of the true value and then not let irrational stock price movements kind of get into your head, so to speak. So, the bottom line theme of today's blog is earnings determine market price. If you look at a company like Ross Stores, for example, you can see that over a 20-year period, this company has had a very consistent, history of increasing earnings. If I overlay price on that, the point is that earnings determine market price. If I overlay price on that, what I see is that stock price correlates over the long run. Now, in the short run, there's all this volatility. But, if I bought Ross, for example, here at 34 and watched it go down to 25, because I was getting my good earnings here, I would have had total confidence. I would not let fear cause me to do something foolish like sell it. If anything, I would have been buying it because I know that eventually it's going to come back to its earnings. And you'll see that over and over again. In the long run, earnings determine market price. And in the long run, the rate of change of earnings growth is going to determine your shareholder returns. As you can see, Ross Stores has generated a 24.8% compounded rate of return for its shareholders based on a 20+% earnings growth rate. If I contrast that to a company like Eastman Kodak, as you can see here in this 20-year chart, Eastman Kodak has had absolutely, not only have they had no earnings growth whatsoever, their earnings have been very erratic, and since the early part of the decade here, the company's earnings have really collapsed and gone straight down. If I bring stock price into the equation, once again you're going to see this strong correlation. So when I overlay stock price on there, again, I get a lot of short-term volatility. But I want you to notice how in the longer term, the trend follows the earnings almost perfectly. Earnings determine market price. And the point is, if you own a company like Kodak and your stock price is dropping, you need to be very worried because obviously you have a company that has deteriorating fundamentals. On the other hand, if you own a company like Ross Stores that I showed previously and this price has dropped, you have to look at that as an opportunity. That's where you're getting past emotions and allowing your intellect to guide your investment decisions. And my third example is Sears Holdings. It's a company that's been in the news quite a bit. And I want you to know something about earnings here. I want you to see that there were no earnings, in 2001, 2, and 3. Then we had this spurt of, good, strong earnings growth. And then from 2007 to currently, earnings have collapsed. And, when you overlay stock price on top of that picture, what you find out is that in the long run, earnings determine market price. Look how the stock price has correlated to earnings for this company over the last 10 years. So the bottom line is, it's earnings that determine market price. And this company's earnings have been very, very erratic, and so is their stock price. But making those distinctions, having a clear idea of what your company's earnings power is the way to defeat the, emotional reactions of either fear or greed. In fact, what you can do is you can use these to actually exploit other people's fear and greed. And my last example today is one I've shown again before. It's called Dun & Bradstreet. I want you to notice how you had, in the beginning of from 1996, you had collapsing earnings, collapsing stock price. Then you had a nice, little rally in earnings. You got a little rally in stock price. Again, a lot of short-term volatility. Then the, earnings collapsed and the stock price collapsed. But look what's happened to this stock since, calendar year 2000. I think that's very, very important to focus on, that once the earnings turned around, the company began to do well, so did their stock price. So if I go ahead and zoom in on just this last, 10-year period since calendar year 2000, I want you to notice how earnings grew dramatically and the stock price followed that. But also, I want you to see the other side. There was a period where the earnings were so good that the stock price got ahead of itself, but it eventually came back to earnings. But here we had a 14.5% growth rate, and shareholders earned just almost a 14% rate of return, in contrast to the market that was down. So the point is, the antidote for keeping emotions from corroding the framework is to know the earnings power of your companies and focus on that, because this earnings line is always a smoother and more rational line than what can often be very erratic short-term stock price moves. This is Chuck Carvel saying thanks for listening. Talk to you again tomorrow.